Odds and Ends. This is Dave Singh and Rob Friesen helping you get ready for the week. Another StockOdds podcast. Good evening, Rob. How's everything?
We'd like to help them, right? You know, this is why we do this. If we can provide any insights, any tidbits that can help you. Again, frame everything by, looking at things for yourself too, and weighing the probabilities of outcomes, because none of us have a guarantee. We don't know for sure how things will play out. So just frame it with your own research, please. And but hopefully we do have a few takeaways. So let's kick it off, Dave, with what do you got on the docket here?
Yeah, we had such a big week this past week, a lot of selling, big movements in the indices, and we're kind of approaching the final 5 days of the month. It kind of starts on Tuesday, so it's going to be split. It's not all in 1 week, but we are approaching the final 5 days of the month. So I did some work on the seasonality almanac for the last 5 days, but do you want to talk about the indices first and some of the bigger pictures?
Maybe we should frame that. Actually, the first thing is, if we look at the news, like what are the events for the week? Well, Tuesday, you've got January consumer confidence at 10 a.m. Eastern time. That is actually important. The consumer confidence is definitely been shifting. We've seen a lot of sentiment change. So pay attention to that. Wednesday, of course, we have the FOMC rate decision, and that's at 2 p.m. Eastern time. Before that, at 10 a.m., we do have new home sales. That can also be a driver. Thursday, we go into initial and continuing claims. Friday is kind of important with personal income spending, PCE price, and core for December. So again, how are we doing on this inflation front, right? I mean, regarding the Fed meeting, inflation is kind of driving the Fed policy, and markets want clarity. There's a lot of opinions, there's a lot of noise. We've kind of had a little bit more speeding up of the taper program, but I think people really want clarity in terms of the interest rate cycle. And now that the markets are selling off, the banter would increase. Well, maybe if it gets bad enough, they're not going to be so aggressive, blah, 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 right? So that could play into things a little bit. When we're looking at potential saber rattling, the drum of war, you've got Ukraine situation, you've still got Taiwan. So over the weekend, there's been more escalation of, the banter and the conjecture and stuff. So keep that in mind. That kind of, plays a little bit into defensive stocks in general, but also defense contractor stocks. Now, we do have earnings on a couple of them this week, which we'll talk about in a minute here. But it should be a good backdrop. So when I look at the macro, I'm not super excited about shorting oil stocks, even though the market's going down. I would kind of take them and look at them separately. Same thing as defense contractors. I would look at them separately. I wouldn't lump them all into, well, the market's going down, so pretty much you can short anything. It doesn't work exactly like that. Even on the worst days, there's always some stocks that end up green. Let's see. I got that. Over to you, Dave, and then we'll come back. We'll roll back to me. What are you seeing? I just talked about oil and defense contractors. Anything that you see in the groups for the seasonality this week?
In the groups, there's still this bit of a risk-off kind of tone that shows up in the seasonality almanac. One of the things that pops up are Riot blockchain, right? So Bitcoin expected to be down with Riot blockchain as one of the symbols.
Yeah, well, crypto ain't having such a good spell right now, are they?
and some of the ones expected to do well, according to the stats, are GameStop and AMC as individuals. But things like the IWM, the Russell, is expected to underperform the Spider based on the stats.
Yeah, well, that AMC is going to be a part of that. I mean, it's one of the top stocks in the Russell, right? And it hasn't been doing so well anyway. So I don't know. again, here's where kind of the macro and the experience can kind of come in and trump that seasonality, if you know what I mean, right?
Here's one, ARK expected to underperform the spider as well. Minus 1.53 for the ARK fund versus minus 0.62 for the spider for the final 5 days. So again, the higher beta growthier stuff expected to underperform. Things like industrials, XLI expected to do better than the spider. XLU expected to do way better than the spider. So again, more defensive. Real estate, XLRE, also expected to outperform the spider quite a bit. And gold, those are some positive things. Energy expected to do worse than the spider. So the stats say final week of January could be pretty weak for oil.
Well, I know, but again, so that's what the seasonality would suggest under normal conditions, right? And going back and looking back at the last 8 years. The problem is when you take a look at what the drumbeat is saying right now, oil still has some room to move. It's still showing a good relative strength overall to the upside. And now we have more of the war, conjecture going on. So I would just kind of say, all right, well, this is where a macro is directly butting heads with the seasonality.
And financials are another example of that too. Like the seasonality suggests that financials should do worse than the spider, but it's all dependent on the 10-year. If the 10-year starts rallying even further, we could expect financials to do well, actually. So that's another example.
Yeah, I would, rolling back to what we talked about last Monday night, because we did this on Monday, we said we were looking at mid-month seasonality, and we were looking at, because we're kind of in the middle of it, so we were continuing that theme, and we were looking out to Expiration Friday, right? And we said favors XLU, XLP, SMH, and XLK and GDX. Well, 4 out of those 5, we're not too bad. And we said doesn't favor XLF, XLI, and IWM, and those certainly did take it on the chin a lot more. So the seasonality does hold up for the most part, but like I said, you have to ask the question, is there any macro influences that are directly competing with the history repeating itself of seasonality? And that's how you stay really safe and sharp, is you consider what's opposing that normal repeat of history. Okay.
Good. So on to the futures, maybe. I mean,
yeah, let's talk about that. What do you see for the diamonds?
We have a nice bounce back from Friday's sell-off.
Well,
the Dow's 0.6 to 0.8 range for most of the indices. Nasdaq's the best of the 4 indices right now. It's up 0.8%, and oil's up as well, and the VIX is down. So it's kind of like a rebound from Friday's sell-off.
Yeah, did you notice we went on Friday after the close? We went down further in the extended hours, right?
Yeah, and then Bitcoin sold off more.
Right.
As a kind of a leading indicator.
So it has, they have bounced up for now. The Dow is probably more on its support level, or it came close to its support level at the 34,000 on the index, the Dow Jones index, 34,000. The S&P is a ways off from the October low. I'm going to measure more significant support on these by what we saw in October, because here's the thing, we broke the 200-day moving average. So we're below that on these indices anyway. And it's the first time since April of 2020 we've done that. So here we've been, almost 2 years without breaking the 200, and the market's been extremely self-correcting, and now we're breaking down. So this presents a tremendous amount of risk, and it wouldn't surprise me if we had any bounce is met with further selling. That would not surprise me in the least, because I think this whole problem is, let's look back over the last number of years. We've had perfect market conditions. We've had a lot of demand for equities because of the low interest rate, seeking, how are we going to make money? How can we get a return? Well, we got to go into the market. And so we've had a lot of demand. We've had low rates, low volatility. They've been self-correcting markets, and we've had corporate buybacks and all that. But then from that came a ton of SPACs. I mean, every single person in Hollywood has their own SPAC, right? Mm-hmm. I'm being facetious, but you know what I mean. It's like and IPOs and so on, and they came out by the bucket load. So we've got tremendous amount of supply in terms of what people can go into, and we've had more and more ETFs created as well. So you look at that and you go, if people start pulling back, like what do they do first when things start to drop more than just a small correction? Like, oh, here's a little buying opportunity. But when it's like, there's the buying opportunity, you already bought, and now it's going lower, and you kind of like, I don't want to buy anymore. If people just stop buying, but we still have supply, what's going to happen?
It's going to go down.
It's going to go down further, and it won't correct until people are willing to commit again. But the landscape gets really shuffled. The deck really gets shuffled, and you're seeing a lot of these speculative names, high PE names, and we discussed this last two sessions that we did for our listeners. We discussed the PE trade, speculative trade, and I don't see any sign of that changing. I just wrote an article for Stocks Commodities magazine about this is a massive opportunity in pairs over the next, number of months to number of years, if it lasts that long, in terms of things actually mattering fundamentally. Like they actually do matter finally again. Who would have thought? But, everybody's like, oh, well, people like Buffett are, they don't matter anymore. That's not how the markets work. I would beg to differ that at some point earnings actually do matter at some point, maybe.
So it's a regime change back to the fundamental bias.
Speaking of earnings, we've got IBM tomorrow. That's after the close. Tuesday before the open, we have American Express, 3M, GE, Johnson & Johnson, Lockheed Martin, Raytheon, and Verizon. Just naming some of the bigger ones. Tuesday after the close, Capital One, Microsoft, Texan. Then let's roll into Wednesday. Abbott Labs, Boeing, FCX. Those are some of the bigger ones before the open. After the close, we have scanning the list here a little bit. Tesla after and Xilinx. It's in a merger with AMD, obviously. So that's after the close on Wednesday, right? And of course that's FOMC day as well. And then Thursday you've got Alaska Airlines, you've got JetBlue, some airline stuff there. Rockwell Automation, you've got Southwest, so all the airlines on Thursday there, not all, but some. And then we got Valero Energy, Xcel Energy. After the close, some home builders, Beazer, things like that. Robert Half, US Steel, Visa, Western Digital, Juniper Networks. And then Friday, before the open, you've got Chevron and Caterpillar, Colgate. You've got Weyerhaeuser. And so that takes us right up to the weekend there. So, we're in earnings season. We got some big names this week. Keep on top of that. General rule of thumb is, if you don't know what they're going to do, obviously don't necessarily need to hold overnight into earnings. And, if you're doing trading on the day of earnings, remember there's usually an analyst meeting, things like that. So stock can move around a lot. Doesn't really get back to more business as usual until 2 or 3 days after earnings event.
I think Apple Thursday after the close. I don't know if you mentioned that one too. That could be a mover.
Oh, did I miss that one?
Yeah,
Thursday?
Apple, Microsoft, and Tesla are the 3 big ones.
Right. Okay. Thank you. Appreciate that. Yeah, so it's a busy week for sure with everything that's on the docket. I would definitely recommend, getting up a bit earlier, making sure that you got a read of the news and what's happened, in the overnight session, because there's a lot of geopolitical stuff going on. And I think all this liquidity that we've had over the last couple years, has really caused a lack of discipline, of selectivity, and financial prudence. And I think that's coming home to roost. I think, there's consequences to pay for that. And we're in the middle of this potential correction. It could certainly go a lot lower, or we could hold up at the October lows is kind of where I'm looking, both for the S&P and the Qs, the NASDAQ 100, because it's sitting about there right now. So if it breaks its October lows, then I would be concerned that we're going to fall down into the March to May type lows for 2021. So just remember, like the level that we're kind of at or getting close to is very significant, but we're already below the 200-day moving average.
Yeah.
So we've already busted something that was, not even in the sights for a long time.
Mm-hmm.
Now we broke it.
Yeah.
Now we're sitting close to, October lows. Where do we go from here? Do we bounce back up, or are we going to see a further decline? Are you ready for even some weird stuff to happen? Like times when we've been under duress, we've seen fat finger trades, like somebody liquidates a basket at the market and causes a miniature flash crash or something. Mm-hmm. So I wouldn't be surprised, whatever goes on, but I would certainly add more risk. I mean, we've been kind of since September, we've already been talking about greater risk coming into the market. That already happened. Actually, in August and September, we were calling for that. Mm-hmm. And that was partly because of the government debt ceiling and the budget not getting done and all that. So we said more risk. We did recover from that in September and beginning of October, and we actually were able to rally back. Mm-hmm. But now we've come back to that level.
Yeah.
And I think it's significant.
Well, it should be an interesting week, and we'll see how things play out.
Yeah, so definitely keep on the bullish side. Gold is still looking okay for me. Oil still looking good, and some defense contractors, pulling them out of the industrials, and then obviously favoring a little bit more of the defensive stuff like utilities and maybe consumer staples, and still looking at risk off overall, even though we're getting a bounce as we speak in the futures. I don't know if it'll hold. I'm suspecting it may not in light of the current conditions, but who knows? I mean, if people think that the Fed is going to be, kind of changing its tune or adding this clarity and maybe not being so hawkish, maybe we'll bounce already ahead of the Wednesday meeting, right? So All right.
On the flip side, we do get some vicious rallies in the midst of these downturns as well. So that wouldn't be surprise me if we had a.
You're right. I mean, if you go into a bear market at all, you can get some of the most powerful rallies within a bear market, right? So the thing with volatility is you have to stay nimble. So when doing baskets, for example, if you have, or even pairs, if you have a really good yield, return on capital in a very short period of time, it's often good to grab it because it may not last as things swing both ways with volatility. Whereas when you have really low volatility and good breadth in the market, it's usually prudent to let it continue to build and not take, the early money. So that's the difference between volatility and, breadth. Okay.
Well, it should be interesting this week. Let's see how things go.
All right. Well, thanks for your time. Take care.